Hello and welcome to another episode of Darwin Investors. I'm Money Train Mike. I am here all by myself today. The reason why I'm making this video is I believe that covered calls and cash secured puts are going to make up an outsized portion of my 2022 gains, at least through June of 2022. Now, there are plenty of options tutorials out there on the internet, and this is by no means going to be like a complete tutorial on options or how to trade options. But what I have noticed is that very few of these tutorials actually offer like a philosophy or a strategy about when and how to incorporate options into your portfolio. I've seen options videos on like how to turn small amounts of money into large amounts of money using credit spreads and debit spreads or whatever to grow your account. And I've seen others that are like, oh, let's use the wheel strategy and we're going to sell cash secured puts. And then should you get assigned, then go ahead and sell covered calls against your new shares in hopes of getting rid of those shares. But really, that's not my philosophy or strategy at all. And the reason why is because a lot of these types of strategies I've noticed kind of like the centerpiece is the option. And in the case of the wheel strategy, the unfortunate byproduct is the shares that you might accidentally get, right? And in reality, your shares should always be the centerpiece, right? So I think that some of these have it backwards. So make sure that the shares are the centerpiece of your portfolio, and that options then turn around and give you a little bit of like dividends or a little bit of extra cash on your primary part of your portfolio, which should be your shares. Now, I believe that the market is about to get hammered, probably like in February through like June. And the reason why is because I fear that investors are going to really worry about changes in the Federal Reserve's monetary policy. So let me go ahead and share my screen out and I'll show you what I mean here. Share screen, share. So Fed Chair Powell, originally him and the other federal people that work in the Federal Reserve decided they were going to taper $120 billion a month, or excuse me, they're gonna buy $120 billion a month, $80 billion of treasuries and $40 billion a month in mortgage-backed securities. And then they were going to institute what's called a taper, where basically every month they would, instead of buying 80 and 40, they would buy 70 and 35. But then they had this meeting on December 15th, and instead of saying, we're going to only taper 10 and 5, we're now going to double it, and we're going to taper 20 and 10, starting in December, until we get to 0, which will be March. And then after that's done, we're going to start doing interest rate hikes. And these interest rate hikes are really going to spook the market. And they shouldn't, but they will. And the reason why they shouldn't spook the market is, one, we've got amazing revenue growth in our companies, fantastic operating margins. The consumer is still really strong. There's a lot of consumer confidence. Commodity prices are coming down. The price of gasoline is coming down. There's a lot of liquidity still pumping through the market. There's a lot of reasons to be bullish. And so these are reasons why it shouldn't spook the market. Another reason why it shouldn't spook the market is, even now, if you look at our bond rates, they're still coming down. And why is this? Because these big banks can't stop buying bonds. So all that's going to happen is, if you boost the prices of the interest rates of these bonds, they're going to buy it even more, right? If they like it at 1.5, they're going to love it at 1.75, right? But 1.75 or 1.5 or whatever, even 2, doesn't outpace inflation. So it's still not a good place to store money, right? And it doesn't outpace what I believe is going to be a good year in the S&P. Not a great year. I don't see a lot of reason for things to change. It won't be 20%, but it might be 10. And so this interest rate in the bonds at 1.5% isn't going to outpace 10. But what's one good way for us to go from 10 to 20, right? Because I don't want to just match the market. I want to beat the market. That's why I do this, right? And so one way to do that is through covered calls and cash secured puts. So what are calls and puts? Well, each one is a contract, and each contract holds 100 shares. So if you buy one call contract, you've bought 100 shares. Now, you don't do it for the same price that you would buy 100 shares. So in this way, you control a large amount of shares for a very small amount of money. Same way with selling a put. You're selling you're selling the right to buy 100 shares for a lot less money. Well, basically you're controlling a lot of shares for a very little amount of money, and as what they call delta, in this case, decreases, you get more money, or increases, you get more money. So with calls and puts, you have buyers and you have sellers. And so anytime you buy a call, someone's selling it to you. And this person thinks you're going to lose, and you think they're going to lose. So you can imagine that you're at a bit of an impasse here. You can't win every time, right? So sometimes you're going to take losses. You want to make sure when you do it, your losses are small. Because the point of this stock market is to stay in the game. Don't ever get run out. And I'm a conservative investor. I like to hold shares, and I like to sell covered calls. And this is a very conservative thing to do. When you buy a call, that's considered bullish. When you sell a call, that's considered bearish. It's a hedge. We've all heard of hedge funds. Well, it's basically just you're hedging your long position that you love. You don't want to get rid of your shares. You'd prefer to hang on to them and just keep the other person's money that's selling it to you. But you're taking the chance that you might lose them. And so, like today, I sold a covered call, say for instance on Lowe's, and I did this today, 12/31. It expires next week, January 7th. And each one of these options has 3 things to them. They have a strike price, which is 260, in this case 262.50. They have an expiration date, which is January 7th, 2022. And we have a premium, which in this case is $100 or $99.35 after Charles Schwab takes their money. And so what does this mean? It means that if Lowe's finishes at, say, 264 next Friday, I have to sell 100 shares at 262.50. And someone is paying me $100 to make this promise. This is the contract that I have entered today, that if 1 week from now it's over 262.50, I'll still sell it for 262.50. If it's at 260, I still get to keep my shares and I get to keep their money. Now, why would I choose that price, and why would I make that bet on something I like? Well, that all goes back to technical analysis. So if you look at Lowe's right here, what direction, if you had to take a wild guess, just to calculate a risk, do you think Lowe's is going to go in from where it is sitting right now at 258.48? I would hope you think down in the absence of any sort of catalyst, especially as they don't have earnings coming up between now and next Friday. So they have an area of resistance at 261 and an area of support at 245. If they were sitting at 245, I might sell a put against them. But in this case, they're up here next to 261, so I'm selling a covered call against them. And what that does is it acts as another like dividend. They already pay a dividend. It's got a PE of 22. It's got a dividend of 1.24%. So it's a good value. It already pays a dividend. I'm getting an additional dividend of $100 in 1 week by selling a covered call against this position. And this is going to be my strategy going forth in 2022. Buy quality companies and sell covered calls when I think I can go ahead and keep my shares and their premium. So I bought Lowe's for $247 a share. I set a strike price of $262.50. The premium I collected was $100. The termination date is next week. If I get exercised, like let's say it finishes at 264, whatever, and they take my shares, I still get $1,550 plus the $100 in premium. I technically lost, but I still get $1,650. That's because I set those terms. When I sold this, I said, I want this amount of money by this date, and I agree that this is a good amount of money to take, right? If it finishes at, say, 261, which is called out of the money, I will not get exercise. I will keep my shares, and I'll get to keep your $100. This $100 is what I look at as a premium. And this is how I intend to go forward until like June of 22, is buying high quality, good valuation, good dividend stocks between now and then that maybe has a tailwind with high interest rates and high inflation. High interest rates would benefit, say, the banks. High inflation might benefit something like, say, oil stocks. So these all pay good dividends, and they're not very volatile. For that reason, I will not get much premium, but I get a little something, right? And I get their dividend, and I get to weather the storm until you know the skies turn blue again in June. And the other thing I'm going to do is I'm going to sell puts. And again, people they automatically think when you buy a put that you're bearish, and you are, you know, but it's not necessarily that you hate the stock. Like let's say that so a stock that's been having a hard time that I like is Zillow, right? I like them because I feel like they dominate that they dominate what they do. That's Zillow and no one else. And they're down like $60 a share in like the last couple of months. And so if I bought them, I might say, well, what if they go down to 40? Well, I might want to buy a put just in case they go down. At least I don't lose my shirt on Zillow. I like them, or I wouldn't own them, but I'm going to go ahead and buy a bearish hedge against them. But they're near their support. I might sell puts against them as a way of capturing a dividend. Now, this is done a little bit different than a call. Like a call, worst case scenario here, I make $1,650, right? That's not terrible, right? But the worst case scenario here, I have to buy 100 shares, and that can be really costly. And I don't want to get assigned. What I want is a small dividend against a company that I really like a lot. And if I got assigned, I wouldn't mind owning more of those shares. And chances are I already own some of those shares. I would just be adding to a position that I already have. And that's what I've done here with NVIDIA. So let me see if I can go over here to NVIDIA. And with NVIDIA, the last, let's see, since yesterday to today, I've made $55, right? Well, I did that selling puts. So what I did was I sold for $111. The right, so somebody else out there thinks it's going to finish below 295, right? As a matter of fact, 295 minus $1.11 a share, or $111, is 293.89, right? So somebody out there thought they would not only finish below 295, they'd finish below 293.89. Otherwise, they lose money. So they paid me $111 to take this contract. They sold it yesterday, expires today, and they paid me $111. It's a lot of money. Reason why is because this stock has a lot of what they call volatility. It's got a high vega. And so, but you'll notice that I didn't take 111. I bought it back at 91. What else did I do? Sold another one at 141, bought it back at 109. Sold one at 126, bought it back at 142. I lost in this case, right? I lost $16 because I got a little nervous. I was going to be signing 100 shares that I really didn't want. What I want is this little tiny dividend, right? And then finally I sold it, or sold it for 111 and bought it back for 90. So you might ask yourself, why would I not just sell it for 111, take the shares? Thought I loved it, right? Why not just take the money and the shares and then sell a covered call against that position? Well, my point is I don't really want 100 more shares. I also look at NVIDIA, and I think that the actual support of this is around 280. I'm not sure that 295 is a fantastic price. 280 is a fantastic price, right? So don't have that much conviction in 295. But I'll take 55 bucks if you want to give it to me. And if you don't think $55 is a lot of money, why don't you just walk outside and give somebody $55? You wouldn't do it, right? Because 55 is okay. And if you did $55 every single day, that'll get you like $1,000 a month. And so basically what I do on NVIDIA is I sell puts when I think it's getting kind of lower. Now the resistance against this is 324, 321, so about 325, right? So I'm closer to the support than I am the resistance. So I sell puts on NVIDIA for small gains. Now, why wouldn't I just just stay the course? Well, look what the NASDAQ did today. It like dropped off a cliff at the end of the day. And why would it do that? Options, people are like just selling off. They don't, whatever. It's like, you don't want to be caught here what time was this? It was 350. The market closes at 4 o'clock. I would have been sitting pretty with my NVIDIA options. I'd have been up, right? Oh, I'm just going to ride this off in the sunset, take my $111, but no, collapse at the end of the day because I wasn't happy to take 21 bucks. And because I wasn't happy to take $21, I went ahead and got $29,500 of NVIDIA. Not that that would really break my heart, to get the $29,500 worth of NVIDIA, because that's why I did it. But I prefer just to take the small dividend. So when I look at puts, my strategy is to get in and get out, don't get assigned, and take small gains. That's what I do with puts. What I do with covered calls, my strategy is to basically get in near the resistance point and let it ride, because I don't care really if somebody gives me $1,650 or not. Like I honestly don't mind getting $1,650, right? Should I get assigned the puts in NVIDIA? Like, let's say I got assigned, right? And I talked to you earlier about the wheel strategy. If I got assigned the NVIDIA, then what I would do is basically at that point, then I sell a covered call. So I go to NVIDIA. This is a Charles Schwab platform. You see, I would have been assigned. I finished below 295. I didn't get assigned. I don't have 100 shares, but let's just say for the sake of argument, I took the $111 and I got assigned. Then I would sell a call of NVIDIA. It would, let's say it expires next week, right? Let's give it right at the strike price, 295. Sell the open. Someone would give me $650 to make that bet. So this is the reason why people will use this wheel strategy, is because I would have already made $111. And then I would have the shares of a company that I wanted to own anyway, and then turn around and sell a covered call, sell to open for 650 bucks, right? I can't do it now because, well, one, I don't have the shares. I do have the shares, but I'm not willing to sell. And I would get $650 if I was to turn around and sell it. And that's what the wheel is. But it's not the way I play it. I play it for smaller little gains. It's a little dividend to basically it's a little dividend to supplement my main part of my portfolio, my core, my centerpiece of portfolio, which is my shares. So today we talked about like basically how we would go ahead and use our portfolio to make little gains selling covered calls. We've also talked about how if we're at a point of support, how we would sell puts to again supplement, you know, little dividends rather than trying to make these home run hits. You know, sometimes a single and a double and a walk is going to be good. And as a matter of fact, it's going to be really good for the next 6 months. Well, from like February through June, it's going to be really good. It's always really good. It's always decent, but it's going to be really good coming up pretty soon. I hope you got a little bit out of this video. If you did, go ahead and like and subscribe, and then I'll see you next time. Have a good day.